Tomorrow we'll witness news that'll make headlines worldwide and send Trump into a rage. Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, in less than 24 hours, an explosive piece of news will drop, which will spark global controversy and unleash Trump's anger. And speaking of explosive news, our tariff being traded is up almost 12%. Stay tuned to the end. I'll show you how we did it and how you too can jump on our next big trade. Now let's head over to Bloomberg, because what's coming tomorrow is going to change what everybody thinks about the U.S. economy. As U.S. jobs will get marked down, but not as much as once feared, and it's all about the labor market. When we talk about the U.S. economy, it has everything to do with jobs, has everything to do with what people are making and how many hours they're getting at their job. And right now, the labor market is about to get hit because the BLS is about to make a big change in what they've said was the strength of the U.S. labor market. Every year, the January employment report from the Bureau of Labor Statistics comes with revisions for the 12-month through previous March. And those backwards-looking adjustments to the data traditionally don't get much attention, but they're going to this time because the agency's preliminary estimate in August suggested the downward revision would be 818,000 jobs, the largest since 2009, meaning the government has been massively overestimating the number of jobs it says it's created. And this is a big issue because when you look at it from an investment standpoint or from a business standpoint, people look at the government statistics, they look at the labor market, and they make decisions based on it. And this is a huge problem. And there's nothing more clear of this than when we take a look at the JOLTS, or the Job Opening and Labor Turnover Survey. That's in blue against the NASDAQ 100 in red. And let's go back to 1999, because I want you to see the correlation between the labor market and the equity markets. We can see that job openings were on a decline. What happened, as we all know, we went right into a dot-com bubble and stocks burst. And what did we see around 2007? We see a peak in job openings. They start to head down, and that gives us a signal the market has peaked as well, and we're right in the midst of a financial crisis. Now, things change a little bit around 2019, because what happens, the JOLTS survey is getting very clear that we're heading into a globally synchronized recession. Investors are buying the dip here, and that pays off after we go into the pandemic and stocks shoot up. But look what happens. The relationship gets back in sync right around 2022. The market comes down, job openings come crumbling down, but there's a problem here because job openings have continued to decline, but investors say, look, we think the economy is booming, we think everything's going to be okay. But if you go back and remove 818,000 jobs from the report, well, you've got an issue. And how did this happen? Well, it's simple. We used to have people at a local level doing payrolls. It's all been consolidated in Washington. The data is inaccurate. The government knows it. And the big problem is they're going to do nothing to change it. Once a year, the BLS benchmarks the March payrolls level to a more accurate but less timely data source. That's called the Quarterly Census of Employment and Wages, that's based on state unemployment insurance tax records and covers nearly all U.S. jobs. And that's a good thing. The problem is we don't get it that often. Meanwhile, the establishment survey, as it's known, will also be affected by adjustments the BLS makes to a so-called birth death model, which accounts for the net number of business opening and closing. Now, what's really interesting about the birth death model, it's entirely fictitious. The government estimates how many businesses they think are starting and how many are failing. Well, this is a problem because we're going to potentially get massive revisions. And again, the issue here is you have people making decisions about their business, their investments on payroll data that we know is highly inaccurate. But yet they say if wage growth and weekly hours worked remain stable despite the downward revision in employment that's expected, it would reinforce the idea that the economy remains resilient. Meaning it doesn't matter if the labor market is revised down. It doesn't matter if the numbers have been bad, as long as people are still making money and getting the hours they need. But we're going to look at that a bit closer here. And that revision is more about accounting adjustments than true economic slowdown. The reality is, I'm going to show you the economy is slowing down, but something that is booming and booming big is our tariff being trade. Check this out. We told our subscribers to buy right here. It pulled back and it's taken off. It's up nearly 12%. And here's the even better part, 10 of our recent trades, all 10 of them that we've got on the books are all up right now. Stay tuned to the end of the show or check out the description below, because let's take a look at this chart of average hourly earnings of production of non-supervisory employees. That's shown in blue on a year-over-year rate of change against against average weekly hours of production of non-supervisory employees, because what they're saying, as long as those two things hold up, that everything's okay. But yesterday we talked about how average hourly earnings don't really matter. There's really nothing that they do. But let's look at this relationship, because we can see very clearly what's likely coming from the economy, and I'm going to tell you why President Trump is going to be outraged. Let's first go back to 1980s, and what do we see around 1987? Average hourly earnings are headed up, so that would give you the impression that the economy's strong. But at the same time, employers are cutting hours like crazy. We go right into a recession. Let's fast forward to 1998. Once again, we see average hourly earnings on the rise. At the same time, employers are saying, we're giving you less hours, right into recession. Again, in around 2007, we see decelerations in both, right into a financial crisis. And look where we're at now. The experts are saying, look, as long as these two things remain stable, it's okay. But the reality is we're going to see a continued deceleration in average hourly earnings, and the probabilities that weekly hours are going to decline at some point are high. Because if we look back over time, we can see the inflection point over the last couple economic cycles is right where we're at now, suggesting if there's a further decline in hours worked, that we're in big trouble. And that is going to outrage President Trump, but not for the reasons you think. Should payrolls figures get marked down and the household survey's measure of employment revised up, that would close the gap between the two measures. So the government knows there's a problem here. We can go back and look at the gap between the household survey and the establishment survey, and what do we see? There's virtually none. But look at now, we see this huge gap, and this divergence between the two has caused debate among the experts as to which survey is more accurately characterizing the labor market. The problem is no one actually knows what the state of the U.S. labor market is. Now, why is this going to outrage President Trump? Because just recently he said that he stood behind the Federal Reserve's decision to hold interest rates where they're at. Now, if it turns out that the data is this bad and there's a massive revision, what it's going to tell us is the Fed should be cutting rates, and aggressively. He's going to be outraged that they should know this and should be cutting rates. Wait and see what his reaction is, because we already know things aren't going to look good. As we turn to U.S. initial jobless claims that came out today, which said, hey, it picked up. Well, that's a problem, and is now near pre-COVID levels. But that's not the real story here. New claims increased by 11,000 to 219,000 in the week ending February 1st. Now, historically, these numbers are still very low. So on the forefront, this isn't the issue here. We can go back and say, well, they're pre-pandemic levels, and yes, the economy is slowing, but that's not really the issue here. What the real issue is, it's continued unemployment claims. Check this out. Now, the article only put a little footnote about it, but here we can see on a seasonally adjusted basis, continued claims rose by 36,000. Now, strip out the seasonal adjustment, they rose by 82,000 to 2.25 million. And the problem here is that coming out of the holiday season, it's normal for employers to lay people off. That's why we've seen the seasonal adjustment the way we have. But the issue here is it should be bottoming out. We should start to see the economy back into expansion mode, particularly the labor market. And I warn, if we saw more people get on continued unemployment claims and get stuck there, this is a huge problem. And what is the data telling us right now? That 36,000 people, according to the government, did add to the continued claims. And if you take out that seasonal adjustment, it's 82,000 people. The labor market, my friends, is going in the wrong direction. And I think tomorrow, the Bureau of Labor Statistics is going to confirm this massive inaccurate data that we've run policy by for this last cycle. That's going to outrage President Trump. He's going to say the Fed should be cutting rates, and it's hard to argue they shouldn't be. The U.S.-based employers announced almost 50,000 of cuts in January, the lowest count for the first month of the year since 2022, which was a record low. That, according to Challenger Grain Christmas. The numbers may pick up this month, they said. Over the past week, several high-profile companies said they had planned to reduce their staff, including Workday, General Motors, and Estee Lauder, and those are among the few that we've covered on the show. And that's an issue because everybody thought, okay, the economy's coming down, it's slowing down. We have a new president, new administration, new policy. Everything's going to be okay. Manufacturers came out and said, look, we think everything's going to boom after the election. And briefly it did. We heard from small business owners. They're super optimistic here, thinking, yes, everything's going to get better. But the reality of the story is the labor market is not what we think it is. We don't even know what it actually is. And the problem is, if we continue to see average hourly earnings decline, if we see weekly weekly hours worked drop. It's telling us the economy is in a dangerous position here, one where the Fed, assuming policy works here, should have been far more aggressive in their cutting, not standing pat. We know this is going to outrage President Trump. And let's take a look, because it all does eventually impact the market. Now, remember, we talked about how investors were super bullish here coming out of 2023, but let's go back in history to 2000. What do we see? Continued unemployment claims shown in blue on the rise, NASDAQ 100 in red on the decline. We see the same relationship going into the global financial crisis. And look what happened. When continued claims bottom, the market responded, and it did exactly what it's supposed to do. It came down, and then investors got super bullish, and it's taken off since then. So what investors are saying is, we see the next big bull market. We see a massive economic expansion here. And what is the labor market telling us? They don't see that at all. And this is a problem, because if continued claims continue to go up here, it tells us we are indeed headed into a recession. And we also got the productivity data today, which rose at a solid pace. Not a good sign. I'll show you why. Helping limit U.S. labor costs. Well, the problem is workers need higher wages. We've been talking about how workers are not keeping up with inflation. This is a problem, because in our economy, we need them to spend on the discretionary side. So if wages aren't keeping up with inflation, with rent, with energy and food, well, there's a problem. It means less money being spent on the other side of the economy. That eventually impacts those businesses who cut hours, cut jobs, cut wage growth. It's all here. And let's take a look. Because productivity or non-farm employee output per hour rose at 1.2% annualized after a revised 2.3% increase in the July to September period. So it slowed a bit, but still on an upward trend. Now, how do you get rising productivity? Well, it's pretty simple. As an employee gets to know their job and gets more efficient at it, their productivity rises. And this is usually a good sign. Now, the problem is, in a weakening economy, it's a terrible sign, because what happens, the most productive employees keep their job, well, the other ones go. But in a booming economy, as people get more productive, well, you hire on more workers, teach them, and train them. Let's take a further look here, because for all of last year, productivity increased 2.3%, the most in 14 years, excluding the pandemic surge in 2020. Now, in boom times, rising productivity means rising wages. And that's a good sign, because it means a person goes to their employer and says, look, I'm doing twice the work I was doing before, but I'm not being paid for that. I want a pay raise. Employers usually respond in kind. But look what happens when we head into a recession. As we look at labor productivity in terms of output per hour against average hourly earnings, that of production and non-supervisory employees in red, both shown on a year-over-year rate of change. And normally you see that when productivity is rising, well, employers are happy to give out raises. The problem is, when you see, as we go back here to 1990, productivity on an upward trend and wage growth going down, well, it tells you you're going right into a recession. And if you don't believe that, look what happened right around the dot-com bubble. We see productivity rising and employers saying, look, we can't give out as big of pay raises. We see a deceleration there right into a recession. Happened again during the global financial crisis. And now we're still seeing an upward trend of productivity. Yes, it did pull back over the last quarter, but look at the downward trend in average hourly earnings. That is the red flag here. So what it's telling us is that employers are not able to give out a big pay raises as much as they perhaps want to. Employees being more productive, and maybe the real reason they're doing that is because they want to keep their job. Let's take a look at now when we compare it to the unemployment rate, we start to get a much clearer picture of why productivity is rising, why certain workers step up and say, I'm going to do a lot more. It's because people are losing their jobs. Let's go back to 1990 here, and what do you see? The unemployment rate rising right alongside labor productivity. There's your red flag, because it happens again going in the dot-com bubble, again during the global financial crisis, and starting to happen now. We're at the early stages here. So if we start to see productivity rising again, as the unemployment rate heads higher, it's a foregone conclusion. The U.S. economy is indeed headed into a recession. It starts to make perfect sense why President Trump is going to be absolutely outraged here, because he's going to look to the policymakers, and this is their job. They should be studying the data, they should understand the economy, and they should be making policy against it. The problem is, what we're about to find out is the Fed's making policy against very bad, very inaccurate data. Not a good look for the United States here. Now let's compare it to what happens to inflation as we continue with labor productivity in blue against the consumer price index in red. That also shown on a year-over-year rate of change. And surprisingly, when productivity surges, well, what we see is inflation coming down. Now, it's very interesting because why does this happen over and over again? Is it because employees are just so efficient that somehow it drives costs down? Well, what it does, though, is it drives labor costs down. Now, think about this. If you've got 3 employees and you get rid of 1 because the 2 can do the work of 3, it's saving you money, and that means productivity up, costs go down. We see that relationship going into each and every recession, and now we're facing it as well. If we see downward pressure on the consumer price index, well, that means labor productivity is likely going up. But right now, what we can see is there's a potential that the labor market is going to feed into a disinflationary trend. But hang tight, because unit labor costs are giving a slightly different impression on that. Because unit labor costs when businesses pay employees to produce 1 unit of output increased at 3% following a revised 0.5% advance in the prior period. Now, previously we talked about that if that starts to go negative, watch out, because it's a massive disinflationary sign. What we're seeing now is employers are still having to give out bigger pay raises than they perhaps want to retain talent. And that could feed into some inflationary pressures, as labor costs are the biggest expense for many businesses. So firms often seek out new technologies and upgrade equipment to make their workers more efficient, helping blunt the inflationary impact of higher wages. Now, one thing we do know, we've heard this recently, is that businesses are giving out higher wages. They do want to keep their best talent, and so what we've heard is they're passing on those costs into the CPI. So that could, of course, increase consumer prices there. So we have differing opinions here. Productivity is kind of giving us an indication that there's downward pressure on prices, and yet unit labor costs are telling us there's perhaps upward pressure. And here we can see that relationship very clearly as unit labor costs in blue rise against the CPI heading up. That's shown in red. See that happen again around 1999. You see that trend between 2004 and 2006 before things started to fall apart. And look where we're at now. We've been seeing this rising trend in unit labor costs against a downward trend in the consumer price index. The reality is businesses are now telling us they're going to have to pass those costs on. The problem is we know that workers can't afford those higher prices. It's only going to be a matter of time before we see workers reject those higher prices and a disinflationary trend return. But in the short term, those higher prices tell us we're headed right into a recession. Another government report closely watched by the Fed showed that last week employment costs rose in 2024 at the slowest pace in more than 3 years. So it's possible that the unit labor cost data is outdated now, behind us, and that perhaps indeed we're seeing costs come down. If that is the case, then it tells us the disinflationary trend is going to continue. But what's more is uncertainty around President Donald Trump's economic agenda may put a dent in spending in the near term, but I don't think that's the case. I don't think that's an issue at all. I think the real issue here is that workers do not have the wages they need to keep up with inflation. We know that the labor market data is highly inaccurate. We're going to find this out tomorrow because it's going to send shockwaves all over the world, because right now everybody thinks the U.S. economy is far stronger than perhaps the data actually suggests it is. But something that is strong and surging higher, that is our inflation and busting trade. Let's take a look as we put this trade onto our subscribers. Back on January 10th, that trade up as of close of business yesterday, 11.95%. And we put in the notes against the report every day. I review the trades and tell them what they should do. And here we said buy it open. We set the upside target. We even give you risk control levels. This is fantastic. You've seen the chart. It's taking off. And right now, I looked at our report. The last 10 recommendations, we have 10 open trades right now, they're all up. Isn't that wild? And how do we do it? Well, every day we look at how the machines are positioned, because they trade hundreds of billions of dollars. Now, what we try to do is position our subscribers buying ahead of the machines and let the machines push, of course, the market higher, and then we try to tell them to get out before the machines cut and run. And we do that every day. Again, you get the daily report, you get all the signals. I review them and tell you these are the trades I think are the best. We fully have back tested our reports to validate they work. We give you risk control levels, a weekly update on tracking on all our open trades. Not to mention, I disclose how I'm trading the reports, and the best part is you get a 30-day free trial. We tell you all in the notes. You don't even have to read the report. We just give you the notes below. But if you want the data, if you want to know how machines are positioned, we tell you how to read it, and then we tell you how to trade it. Check out those links in the description below, and be sure to use those coupon codes for your free 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.